The next dominant organizational form to emerge was the Bank Holding Company, or BHC. A holding company is a shell corporation that owns a group of other firms or subsidiaries. A bank holding company owns one or more bank subsidiaries. For example, let's say it's 1950 and I own a very successful bank in Champaign, and I want to expand my operations to St. Clair County, say because I want to geographically diversify. Now, Illinois only allows unit banking, so this is impossible. One way to evade the restriction on branching is to first launch an entirely separate bank in St. Clair, and then second, I can establish a holding company that acquires both banks. These bank subsidiaries may be considered independent banks and therefore in compliance with the law. For good measure, why not have my holding company open up a non-bank subsidiary that offers some wealth management services as well? Since this non-bank is not directly affiliated with any bank, then I'm probably okay, right? This type of behavior is often called regulatory arbitrage, since it exploits loopholes in the law. With the 1956 and 1970 Bank Holding Company Acts, Congress attempted to close these loopholes, but by that point the cat was well and truly out of the bag. I've now expanded on our earlier chart into the 1980s. As it shows, by the 1980s, bank branching, often via these bank holding companies, became the dominant organizational form. Some view the period from 1935 until 1980 as the heyday of US commercial banking. Banks had monopoly power as an industry. This gave rise to the famous 363 rule of commercial banking. Here's a quote. American bankers for decades operated by the 363 rule, pay depositors 3% interest, lend money at 6%, and tee off at the golf course by 3 p.m. They could afford to be that precise because federal and state laws set the strict rules by which they operated and protected them from competitors. As a result, the power and prestige of bankers remained as secure as their vaults, while the profits were steady and certain. However, all of that began to change beginning in the 1970s and 80s. Suddenly all that's gone. Bankers now face their most strenuous survival test since the Great Depression. Okay, back to our chart. The number of unique commercial banks in the United States peaked around 1985. After that, there was a collapse in the number of separate institutions. This was a period of dramatic consolidation. By 1999, the number of banks had roughly halved to around 8,000. So what were the main causes of this consolidation? First, technology. Beginning in the 1970s, the local nature of banking became less important. As mail, telephones, fax machines, and eventually the internet became prevalent, we lost the need to walk into our neighborhood bank and speak to a loan officer in person. Nowadays, we can manage our deposits, debit card, mortgage payment, all of that stuff from our smartphones. I can get a loan online from a bank on the other side of the country. All this began in the 1970s. The second major shift came from financial innovations in debt markets. This was an assault on traditional banks in terms of their ability to raise deposits and make loans. Substitutes for deposits arrived. As we mentioned before, under Regulation Q, banks were limited in their ability to pay interest on deposit accounts. Beginning in the 1980s, money market mutual funds came on the scene. These mutual funds are non-banks that also offer deposit-like accounts. Super safe, very convenient. But these funds are not subject to Regulation Q. Substitutes for bank loans also arrived. In the 1980s, there were seismic shifts in public bond markets. In terms of corporate finance, short-term commercial paper and long-term junk bond markets emerged. And then securitization, which created a brand new funding model for bank loans. This caused further disruption for the banking industry. These were the major sources of competitive pressure for banks. Local banking monopolies were disrupted. This forced banks to make hard choices: go out of business, scale up organically, or scale up via merger or acquisition. By expanding, banks could try and exploit economies of scale and economies of scope. This usually involved eliminating redundant costs.